So, JC, we were texting this weekend. We were both home looking at charts like we always do on the weekends. You asked me what my bearish case for U.S. equities would be right now. I didn't have much of a response for you. Then you put out a tweet and started a nice thread on Twitter where everybody responded with their most bearish charts right now. So I want to know, where's your head at when it comes to the bear case for equities?
Yeah, for me it's hard because I don't really have a bear case. All of the things that you and I have been talking about the last several months, transports and Russell 2000 holding, things like that, the S&P 500 on a relative basis, all these things that we were looking for to show constructive action and accumulation from institutions, we've seen all those things. So yeah, I think stocks go up, not a secret. But you always want to take the other side, play devil's advocate, try to visualize what the market environment would look like in the off chance that we don't get it right? Just assume we're wrong. All right, so let's think about it. So I put it out on the Twitter. I should be doing this more often, kind of opening it up. Great thread. You can see it here. I highly encourage you to go check it out. We have it in the show notes down here below, so you can click. But one of the things I wanted to participate to, right? So one of the things that stood out to me, first of all, consumer staples outperforming, right? So when markets are going higher, stocks are going up, the lower beta, less volatile consumer staples are going to underperform when stocks are doing well. They're going to outperform when stocks are doing poorly. So in the fall, as the S&P 500 was trying to make new highs at the beginning of the fourth quarter last year, consumer staples had already started to outperform. So we saw what I would consider a bearish divergence in the staples ratio, and that was one of the many reasons we were so bearish in the fourth quarter. So now let's fast forward to now. Here we are at the end of September, almost a year since that point, and what's going on? Consumer staples are still in an uptrend relative to the S&P 500. So what we want to see is start to see rotation out of consumer staples and into some of the other areas. So what is the market going to look like if we're wrong and stocks are going lower and we're better off selling stocks? You're going to see consumer staples breaking out on a relative basis, which hasn't happened yet, but that's one of the things that I think we'll be seeing if stocks are going lower.
And so you're looking at the ratio of large cap sector spider XLP over SPY?
Yep, that's exactly right. So what I like to do is I like to actually flip that ratio upside down, which I know is counterintuitive, and have the S&P 500 as the numerator, staples as the denominator, so that way that chart looks exactly like the S&P 500, and you could really look for divergences. The top in 2015 was marked by a divergence there. The bottom in 2009 marked by a divergence there. The top in 2007 marked by a divergence there. So this is a really reliable indicator that when we include it with all the other things that we're looking at, I think it's a good heads up of risk on, risk off, sort of risk aversion versus risk appetite. So that's consumer staples. I'm also looking at industrials. So historically, industrials have the highest correlation with the S&P 500 over time, believe it or not, the XLI of all the sectors. And we tried to break out last week, or we're in the process of trying to break out. So what does the market environment look like if stocks are selling off and we need to be selling, not buying? This is going to be a massive failed breakout in industrials. You can see it here on the candlestick chart. And you could also see it here on the line chart, right? Just closing prices. Both tell the same story. From failed moves come fast moves. If stocks are getting killed, this chart's going to be a leader to the downside. On the flip side, however, if we're right, expect to see new highs in the industrials soon.
And I mean, failed breakouts have kind of been a characteristic of the U.S. equity market for the last 20 months. I mean, if we got bearish on stocks every time there were a bunch of failed breakouts everywhere, we wouldn't be participating for the last 2 years.
Strazza, the more times the level is tested, the higher the likelihood that it breaks out. I mean, that's just the bottom line. Sure, we've had a couple of false starts, but guess what? Go back to 82, the beginning of the, the greatest bull market ever or whatever it is. That was a sloppy start, like really sloppy. Go back and see that some of the greatest breakouts of all time weren't clean ones. So I think that's okay. And I know you mentioned large caps. One of the interesting ones is that if you really want to look at the small cap, large cap ratio, if you want to make it more obnoxious, which I like to do, instead of small caps, we're looking at micro caps. instead of large caps, we're looking at the mega caps, the biggest ones of them all. And when you compare those two, it gives you a really good idea of the small cap to large cap ratio. And you know where the Russell micro cap versus the Dow Jones Industrial Average just happens to be today? At the 2009 lows, which, as you recall, was a historic low in the US stock market, right? So if there's gonna be a time, if there's gonna be a place for small caps to start getting that rotation and we start to see outperformance out of the smaller cap names, this is a perfectly logical place for that to start. So what does the market environment look like where we wanna be selling stocks, not buying them? I think the ratio of micro caps to the Dow Jones Industrial Average is breaking below the recent lows, is holding below the 2009 lows, and we continue to tumble from there. I think if stocks are selling off and we want to be selling stocks, most likely that chart is breaking down to new lows.
So along that same theme, we recently saw some strength from the Russell 2000 and microcaps and midcaps, where that ratio started to tick higher, whether it's IWM SPY, like you're talking about, microcaps versus megacaps. They all started to tick higher, but then this past week, we kind of saw that trade unwind a little bit. What do you see in the near term? Do you think we're finally gonna enter an environment where small caps are outperforming?
I think so. I think in an environment that stocks are going up, which we think it is, I think we're going to see rotation into the small caps. We've already seen it into the mid caps. Of the non-large caps, the mid caps are definitely the strongest ones. And it's not just like the market capitalization. It's also the alternatives. We talk about that all the time, Strazza. If an asset's in an uptrend, it's a strong uptrend, it's not just doing well on an absolute basis. It's also outperforming its alternatives. So we're talking about the S&P 500. We want to compare it to gold. We want to compare it to treasury bonds, right? And about a month ago, 6 weeks ago, you and I had this conversation and said, listen, S&P's relative to bonds, S&P's relative to gold, they're flirting with those late December lows, right? So if they don't hold, that's a big problem. They held. Okay, so far, that story's intact. We held those lows and now we're outperforming, or we have been over the last month or so. So what does a market environment look like where we want to be selling stocks, not buying them? I would argue that S&P has broken below the recent lows, which are also the December lows, both relative to bonds and relative to gold. That's what that market environment most likely looks like.
So you talk about stocks, you're talking about what we're seeing in the bond market. How about anything from the commodity or currency market? Is there anything there that you're looking at that could turn you bearish?
You want to know something? I'm looking at this copper chart, right? So copper, we've been saying if it holds 255, got to be long copper, which is, a lot of people don't trade commodities. A lot of people don't trade copper. Most people don't, quite frankly. But take a look at this correlation between copper futures and emerging market stocks. They look exactly the same. So whether you trade futures or commodities, or whether you don't know the first thing about copper, you don't want to touch it. If you have exposure to emerging markets, which most people do in fact, you really do want to pay attention to what's happening in copper. This 255 level has to hold, which so far it has, right? So if copper's ripping, emerging market stocks are doing well in that environment. So when we talk about JC, what do you have to see in commodities that would suggest selling stocks is better than buying them? I think it's copper breaking back below 255. I really, really do, because I think that's going to put a lot of pressure on emerging markets. Dollar's probably doing very well in that environment. Copper's selling off, emerging markets selling off. That's not good for the stock market, in my opinion. So if we're wrong on this, we're in an environment that we want to be selling stocks. I think you'll see copper below 255.
I think just in general, what we've seen in recent months is more risk-on commodities like copper or lumber. They're really struggling, even crude oil, while the more risk-averse metals like silver and gold are really starting to outperform in that space.
Yeah, that's right. And we could see rotation out of that and into some of the more base metals. And we're seeing that, right? We're taking a look at a chart here where we're equally weighting a series of base metals, nickel, tin, aluminum, copper, right? Not just copper, but the other ones as well. And I got to tell you, we take a basket of emerging market currencies, particularly the BRICS, and we compare the two, and they look exactly the same. So I think these levels really need to hold in base metals, in emerging market currencies, which are tied to the stock markets over there in some of the emerging markets. So yeah, 100%. We want to start to see rotation back into some of the base metals, not so much into the precious metals. But you want to be a little bit careful with that, because just because precious metals are going up doesn't mean the US stock market can't. I'll take you back to early 2016. Precious metals absolutely exploded off the lows in early 2016, and stocks did very, very well. Thank you very much.
Yeah, that's a great point. Anything else that we should know when we're thinking about bearish case for equities?
I think just keep an open mind. You know, I learned my lessons the hard way many, many moons ago, to not be stubborn, not be hard-headed. I see other people being incredibly stubborn and hard-headed. That is not a recipe for success. Check your ego at the door. Understand none of us have any idea what's going to happen tomorrow or next month. None of us do. Not Carl Icahn, not Warren Buffett, nobody. Not JC, not Strazza, right? So keep an open mind. As more data comes in, we'll continue to reevaluate our thesis, look for good risk-reward opportunities, and that's all we can do.
I think that's great advice. All right, thanks, JC. We'll check back in next week.